Well, hello folks, this is ICT with the ICT Pro Trader Club. Technical review for the fiber today. Yeah, we're looking at the Euro versus USD. Before I go into why I chose this pair versus the cable, while I have the chart up and everything loaded, I'll detail the two setups that, actually three setups that transpired for Friday's session. Okay, we have New York midnight delineated here. Okay, this is Thursday's trading going into North American new day, and our pivots from previous day are R2, R1, central pivot, and the midpoints between central pivot and R1 comes in approximately in this vicinity here, right at this old Asian session low. Started a new day going into softer trading down to a new Friday session central pivot, and like I was indicating in previous lessons, when you have a new day starting at or very close to the central pivot, the trading is somewhat 50-50. Even though the technicals may look like there's a really good setup there, you have to take it with a grain of salt. And if you're going to be trading 2% on your trades all the time, whenever we open into a new session, like it be Asian, London, or New York, North American trading, you want to be reducing your risk to only risking 1% or even less, because the probabilities they fall off, in my experience, when we start trading near the central pivot, because central pivot basically is viewed as a technical measurement of fair value or price equilibrium. So whenever we see disparities or moving away from the central pivot, okay, that's when we start seeing a deviation from what would be considered technically fair value, and that's where we see setups trade. They come into the market when there is a think of like price as an elastic band, okay, and this is the anchor point, and price is a rubber band. If you stretch price away and up away from the central pivot, at some point when there's no more momentum to pull the band higher and stretching it up, when that pressure is abated, it'll start to snap back. Where it's going to head, just like a rubber band would, it would go back to the point where it's anchored from. Doesn't mean it's going to go all the way back down to it. And same situation here. Price was at the central pivot and stretches, gets to a point when no longer there is a near-term pull from fair value, okay, and price will pull back to the central pivot. Now at some point, the anchor point will give way, much like if you have a rubber band on your finger, you stretch it back and you let go of it and it's no longer anchored. Where's it going to go? It's going to shoot off in the direction it was pulled away from, which is what we have in this situation here. So just a real quick elementary way of explaining how price moves in expansion and contraction, and why it moves away from the central pivot like it does, and the indications it can give you as you enter new trading sessions. So with that, there are two trades set up that I want to go over that I did not take part in. There was one in here where you could have scalped a bounce in here. I know it looks like very little in here, but you know, that was a tradable little scalp in here, and you could have been keying off of this Asian low from the previous day. Also, since you have the R1 here from previous day on Thursday, and S1, I'm sorry, central pivot, between central pivot and R1, what level rests between there? MR1, okay, which basically basically in this area here. So when we traded back down to the central pivot, it overlapped with a previous session MR1 midpoint pivot, and you could have traded that little bounce in here for a scalp. Now, when price traded lower, here, this line here delineates 3 a.m. London open, North American time. Okay, price traded down and then back traded right into the central pivot again. So we had all this consolidation around the central pivot. Price broke down, made a new low, and then traded back to the central pivot. Now, I don't want to block all the chart out because I want to go over everything, but kind of like imagine this portion of the chart from here out doesn't exist yet. All you have is this. What is this right here, guys? What time of day are we at? We are in London open. We are trading near at the pivot. We've already traded down, made a new lower low for the day, and then traded back to a reference point. Now, Friday's central pivot overlaps with a mid pivot from the previous day. We've already seen price react to it, so we have two anchors or reaction points to reference price from, and then we traded back up to it. Well, if you draw a fib from the high to the low, yeah, it's gonna drive me crazy here trying to drop it on here. Well, if you draw it on here, and again, this is a 5-minute chart, so since my trading has been basically scalping recently, because I wanted to make sure my longer term analysis was in line with my swing trading, you can see that optimal trade entry actually overlaps with the central pivot, and that was a nice little London session short. Now, I did not trade this one, and I did not trade this one, but if you look at the high to this low, use swing projection, you get the S1 level in here, which essentially price was able to find support in here. Moving along into New York, North American open, 7 a.m. Eastern New York time. This little concept, I haven't talked about it yet, but you've been seeing it. Wherever you are on the globe, you want to reference the opens and close of each session. In other words, you want to note on your charts where the London open is, where the London close is, for instance here, and where midnight is, New York Standard Time. Okay, and they're kind of like crosshairs. You want to have those already in place because they're your focal points. Whenever you're not trading at those time frames, there's nothing to do. You don't want to sit in front of your charts. You don't have to worry about it. There are pockets of the day in 24 hours where you just want to be focusing on an opportunity. If the opportunity doesn't materialize based on your analysis, you let that session pass. You go to the next session. Okay, I actually was sleeping until 6 o'clock in the morning. Because of the cables price action, I wasn't really interested in trading, but I made a point to be up at 6 o'clock in the morning on Friday to check and see what London going into New York would look like. And when I woke up, I saw this situation in here. Now, price traded down to S1, down again. Okay, optimal trade entry was effective in here, and buying at previous day's central pivot, Friday's S1. Also, we've already met the targets for London session short, and look at your price over here, 135.55. We're just below that central pivot to S1. Nice little healthy range. So price coming down to the S1 for Friday comes in at 135.51, which essentially is what price? institutional level 135.50. Okay, so we have a whole lot of confluence of events. We have North American New York session open at 7 a.m. Price traded down to a. So using the optimal trade entry and 135.50 institutional level, adding the spread to the 135.50 level would give us 135.53, factoring a 3 pip spread for the fiber. Entry only saw about 2 5-minute candles to less than 15 minutes in the trade before it actually started moving up. And initial objective was central pivot, and price really rocketed up. And this price action here gave me reasons to suspect that we were going to try to gun previous day's high in here. Okay, and you can see, let's draw a line on it. Drop a line on previous day's high. Price traded back up above previous day's high right into R1 for Friday, 136.41 basis this feed. Okay, and we had price start to trade back down. Where was it going to find support at? Okay, Friday's intraday high already, and let's note that. Okay, price traded back down to Friday's intraday high, which also comes very close to 136.20, but this is 136.14. So let's just, for sake of reference, let's see what price did at the 20 institutional level. As you can see, we swept below just a little bit, but we were trading back down to previous day. I'm sorry, Friday's high of the day prior to it breaking above. And also, look, we had some support found right at the 20 level here, and moved on higher. Right in here at at R1, the average daily range, you should have had it fill right in here. And then everyone took their profits and went softer and closed their trading session for the week here. But the banks didn't want to have any parts of that. They felt that the daily chart, 4 hour, 1 hour, everything in line for a swing higher, found support in here, and price moved on up. If you take at this point from the low of the day, Friday, up to the high made at that point there, so it's this low to this high. From that point, you have a 38% retracement level on here that it almost got to, and then you have your 23% retracement in here where price did find support, and at the 20 institutional level, bull flag formation. So price projection, we want to take this low here and take our fib, pull the 50% retracement level, and drop it right down on our previous reaction high where we traded down to. See this price swing here, guys, going down? If price trades above it like we did here and then back above it here, where would the price reasonably expect to go? Well, using again this low to this reaction high, 50% retracement level, guys, see it over here? We drug it all the way up to this point here, and bingo, there's your swing projection high. 137 even was my exit. I never really want to try to get the actual projection high because it may not get there. It could miss by a pip or two, and I really want to be exiting in the momentum, in the movement. Okay, so we've had bull flag projection here. So if you measure this low to this high, add it to this low here, you get the general area as well. So we had a lot of overlapping targets. And again, whenever you get a trading day where you expect price to move out outside the normal price range, which would be S1 and R1, R2 offered very little in terms of resistance, and even at the London close time frame, you just want to hold for the close, and that's the only way you're going to get these large range days and capture the lines portion of the move. But that was the trade for the fiber. Now let's go over real quick why I didn't trade the cable. Okay, and if that ain't reason enough, I mean, we had very sloppy, even though it did trade higher, it was very sloppy, so it was very hard for me. I mean, it was very sloppy, and it's been reaching and reaching higher. But overall, again, we opened up going into a new day at or near the central pivot, and it's very difficult for me, even with the experience I have, to adopt a bias that I'm 100% strong convictions behind it, because it becomes a 50-50 setup. I mean, your price is basically at a equilibrium point, and my trading really requires an expansion up or down and trade in some sort of extreme, and then it makes trading much easier. But that's why I basically avoided the cable, because even though we had higher highs and higher lows going in, it just, I don't like the way the structure set up. All your fractals are a mess, and because I trade both the euro and the pound together, and my analysis lends well to using both of them because they're very closely correlated. It was basically a no-brainer for me to not want to trade the pound, and found the euro absolutely the star for the session. Price was a little bit more smoother in the euro, and I wasn't risking much anyway. I risked 1.5% on the trade in here, so like most people, I wish I would have bought more, but that's okay. I mean, it was profitable. But 30% was taken out at central pivot, 30 pips higher from my entry, and then I scaled out another 30% at R2 in the event that we did crash down from London close, but the remaining portion was closed at 137 even figure, so not a bad little trade. I was well over my weekly objective again, so that was kind of cool. But the point in all this is basically when you want to have action in the market, and when you're looking for your tools to speak to you, you have to be using them at the right times. And by doing that, you want to be noting the opens and closes, because that's where all your trade setups are going to take place, guys. All the momentum and volatility enters the market at these times in the day. So it stands to reason that you would have your time frame noted on your charts. That way it's very easy for you to keep it in perspective and expect a sentiment change in the market. Here's a little exercise for you, some homework for this week. I'd like to see you guys take your charts, and only on a 15-minute, or in this case like a 5-minute, because you may be able to see it a lot more dynamic on a 5-minute chart. Not you should be trading all the time on a 5-minute chart, staring at one. I'm using it because it allowed me to get all the price data on one slide for you. But what you want to do is you want to note the midnight time frame, okay? And I'll just use the reference points for GMT, and you can just convert it to your local time. 5 a.m. GMT, which would be my New York midnight, and you want to use 8 a.m. GMT for your London Open, and you want to use 1200 GMT for your New York North American Open at 7 a.m. my standard time. And I have 1700 GMT noted because that's like my noon, but I understand that an hour or so before or after the London trade could take shape. So by having these areas noted on your chart, when you watch price trade down to your support levels and your fibs and your pivots, it allows you to have a much clearer perspective on what price should be doing and what to expect. And that's how you map out your day. And if you do that for this week, I'd like to see some individuals put their charts up in the thread and highlight what they're seeing, because it'll be a very illuminating and insightful week for you if you do these things, because it'll help narrow your focus, and you'll see the impact of the tools at the right time of the day, and you'll see the importance of not feeling like you have to rush to get in a trade and every time you turn your computer on expecting something to do all the time. This way, much like your job, if you have one, you know what time you got to be up, you know what time you got to be at work, you know what time you're going to go to lunch, you know what time you're going to come back from lunch, you know what time you're going to go home for the day. You want your trading to be just like that. And when you build a routine such as we're describing here, you'll find that your trading will actually become very routine, and after some periods of time it will become very repetitive, which lends to boredom, and that's when your trading becomes dynamic, because you're no longer influenced whether or not the price is going to move for you. You just know that you need to be doing X at whatever time frame or session you plan to trade. So with that, guys, I wish you good luck and good trading. Okay, UK Dave. Excellent feedback and encouragement on box post. I appreciate that. I'm sure that most individuals that are just now discovering this thread, and it honestly still is in development, and it will always be in development, because as new questions or inquiries are made, it allows me to tweak the teachings and amplify what needs to be amplified as new questions arise. So I agree that the first few videos are essential, and that's why I spent as much time as I did in between, because like your post says, it's very basically normal for new traders who want to get to the buy and sell signals and hopefully chasing profits, but without the proper mindset. Yeah, it's absolutely true that if you don't have a sound foundation, it can collapse on you. So that's an excellent point. Okay, Shandy's post. Again, I took that same trade, and not that the system is broken or the methods don't work, but unfortunately sometimes we as traders will have losses, and this was understood in all the video teachings, and at the beginning of this video as well there is a risk disclaimer, and I don't put it up there for decoration. I put it up there for the simple fact that we must always be conscious and sober to the reality that just because a previous method or pattern has worked in the past, that is in no way indicative of future results. So that's why we have to have risk management. That's why we have to have a predetermined low risk exposure, and repeatedly do this over and over again, because we will suffer losses. So like the post says, Shandy, you had it right in terms of your analysis, but for that trade, unfortunately, price didn't line up with our expectations, and that's how it goes sometimes. So you strike it up as a learning experience, and hopefully don't lose much on the trade, and take the next one and learn from this one, but more or less forget it, because if you beat yourself up and you find fault with losing trades, you'll end up becoming fearful and emotional about taking the next trade. Again, like the last video and previous videos before, your last trade is your last trade. It's not the trade you're in anymore. You can't make or lose anymore on it. So learn from it. Note what was beneficial and what was detrimental to your bottom line, and use that going forward. But do not use its outcome as a deterrent or a fear factor for future trades. Well, that would be a possibility, Shandy. Me personally, I wasn't taking any action. I just was sitting on my hands. All right, Clark. Yeah, daily 4 hour and 1 hour market flow was bullish, and resistance unfortunately trumps market flow. But again, this is an area where I wish that there was a way for me to easily explain it, where it's a very easy process of doing this, this, and then arrive at the outcome. And it's very difficult as a mentor describing something that is, it resides in a gray area. I mean, the closest thing I can get to is you want white or black, and you can't get that. It's like a gray area where the probabilities lean one way or the other, and hopefully, you're right at the time of the day when you're trying to do it. So, while market flow may be in agreement, if you run into a resistance level or a support level, my trading really is based on that premise. So the first portion of the technical that we learned was the importance of key support and resistance, because without that understanding, your tools won't speak to you profitably without those price levels in mind. Because I don't care what currency pair you trade, I don't care what time of the day you're looking at, every significant price move takes place at a key support or resistance level. And I don't care if it's a news related event, it keys off of a key support resistance level. I don't care which one. You find one chart anywhere, I will FedEx you a $1,000 check, okay, to your home address if you can show me any chart where there wasn't a key support resistance level that was a catalyst in terms of a significant price move. It always is there. It never happens without that being the anchor point. So that's the point in your trading. You want to begin all of your analysis on where are the key price levels. Monthly, you don't have to look at so much. Weekly, you don't have to look as much either. Daily, you want to at least reference that once a day. You want to see where your key turning points are, where you are in terms of flow for the daily chart. Where's price trying to move towards on the daily chart? If you look for just that as your bias, okay, and then find times when your intraday trading and your session trading is in line with that, it could spell a huge dynamic for success and profitability for your trading. Will it reduce the number of trades? Sure, it will. Will it drive you crazy because you like to trade all the time? Yes, it absolutely will. But that gets back to the essentials of why are you doing this? I mean, are you trying to be in here to have fun, like it's casino, or you're playing the roulette or slot machine, or are you doing this as a business? Because let's just face it, McDonald's restaurant, they're not in the business of clowning around, even though their trademark is Ronald McDonald. I mean, they're in there trying to sell food to everyone that wants to pay for it. So this should be your business as well. I mean, you're not in here, hopefully clowning around. I mean, you want to be in here, with a method that has sound principles. And the most sound principle that you can have as a trader is understanding what support resistance is and how it relates to price movement. So I say all that to say that your daily and 4 hour support and resistance levels, okay, don't look at these levels and expect intraday trading to give you so many opportunities, because you want to be moving in a direction of where price on the 4 hour and daily chart are trying to reach to. And that may also be contrary to what market flow is telling you. Okay. And I'll give you an example of that now. Let's take a look at a chart and I'll show you. Okay, in the case of the cable, okay, this is a daily chart, and you can see that this old high in here, okay, that price has not been challenged yet. I mean, we got very close to it on this day here, but you can clearly see that price is trying to get above this, or at least retest it. Okay, market flow up until 2 days ago was down on the daily chart. Okay, so that would have lulled you into thinking that price should be going lower, right? But you have to look at where price was trying to get to. It's been trying to reach up to this point. So when market flow turned bullish, that sets the stage for looking for buys intraday. That means looking for your sessions to open up, going into preferably a region below the central pivot, overlapping with maybe a session high now acting as support, or a session low now retesting as support. That happening with a confluence of support like an institutional level. And when you start seeing like your smart money tool start giving you divergence when those instances take place, then you have really sound setups. Let's look at the euro real quick and see if we can glean something from that as well. Okay, here we have a similar situation. Okay, we have, well, clearly a bull flag formation. Okay, but market flow on the daily chart is still down because we have a swing high, swing low here that was penetrated. So the most recent fractal is a swing low. The previous swing high from that formation is here. So until this high gets taken out on the daily chart, what's the market flow? It's down. Okay, does that mean we can't take buy signals, or that we shouldn't be taking buy signals? Absolutely not. Absolutely not. So this right here, to me, suggests that we're going to try to reach higher. Will we reach as far as this high here? Maybe, maybe not. I don't know. Okay, but what we're looking for is price to try to at least test this high in here. If it can gun through this one, it obviously will try to test this one. We've already tried 1, 2, 3 stabs lower. Okay, so now where's the stops at on the daily chart? It's resting above this high. So even though market flow is down, we have to think like the market makers are. Okay, in other words, they know that there's resting stops right above this high. For anybody that's been trying to go short from here or even here, they've trailed it down to this this high here, and now they're going to try to gun it up and blow out those stops. This is just the daily chart. Let's look at a 4-hour chart, which is another key level chart to watch. You can now see how we've had bullish market flow, okay, on the 4-hour since here, since this candle here. This high was taken out from this candle to the left. The most recent swing low is here. So let's just draw a line on that. Okay, so when price went above this candle here, market flow turned bullish on the 4-hour. That's the time frame that I've told you to monitor as your key bias for market flow. Now you add strength to that by adding the confluence of perhaps maybe the daily being in agreement with market flow on the 4-hour, or the 1-hour being in agreement with market flow on the 4-hour. So 4-hour is your underlying bellwether. You want to look for that one. You don't necessarily need daily to be lined up with 4-hour market flow to have your bias for market flow. You don't have to have the 1-hour be in agreement with the 4-hour. It just adds to the dynamic of the trade, and you'll see a lot of extrapolated moves to the upside and downside when one or all three are in agreement with if daily and 1-hour are in agreement with the 4-hour, you get much more dynamic trade setups. And you don't necessarily need, like I said, you don't need the 1-hour and the daily to do it. You get more strength and momentum in the trades that do have all three in agreement. But going back to our example here, looking at the fiber, the euro made market flow turn bullish on this candle here. Okay, and price made a higher high in here, traded back down, made another swing low, but guess what? it didn't break this swing low here. So market flow is what? Still bullish. Now once we made this swing low here until it trades below it. Now, yes, I'll grant it got very close to it, but it didn't stab through it. Market flow is bullish. So 4-hour market flow on the fiber is bullish, and that's why we saw this extrapolated move on Friday, because everything was indicating it was going to go higher. We traded back from this fractal high down to a key institutional level, 135.50 area, which happened to do what? It overlapped with all of our analysis suggesting that it was a time of day to take an entry. In what direction? The 4-hour market flow on the euro. Okay, time of day, price, support, fibs, everything lined up. And you have also a price level where here's R1 and central pivot. What rests between those two levels here? It's MR1, which is essentially where we've made this turning point here. And then price moved on up. So all these things have to start making sense to you. And by seeing it repetitively over and over and over again, you'll start to see trades develop, and you'll see them not in hindsight, but you'll see future trades, and they'll become pattern, almost like a cookie cutter. You'll start seeing the same thing happen over and over and over again, and it becomes very generic. That's what my trading is. It's based on generic principles that repeat over and over and over again. These methods as a whole can't fail. That doesn't mean me as a trader can't lose. It just means that these methods cannot fail because they operate on the premise of how the market itself trades. The underlying market movement is based on these principles: time of day, fair value, support and resistance. Okay, and if you can get your directional bias based on that going into the day and looking for those tools to line up, it just makes trading so much easier. It doesn't make it 100% profitable, and you won't take a loss. You will, because what will happen is you as the trader will get in too early. You'll over leverage. You'll put your stop loss too tight, afraid not to lose anything, or if you get a small profit, you try to move it too fast to break even, and normal volatility will stab you out of the trade, and then you'll be afraid to get back in it, and then it'll take off like you see here. You could have easily put your stop loss in real tight, came down, maybe tagged it before it took off, which is typical, with a new trader. You just got to give it some movement to hopefully move away from your entry, and you'll start to see your trading take shape with that. But over here also, I wanted to note real quick, these lows in the 17th, these are also reference points as to why we've bottomed out here at S1 for Friday. So they were all factors contributing to the extrapolated movement to the upside. But that 4-hour market flow was your key basis, and why it was reaching for the highs made on the daily chart we've already noted. And yeah, this high in here, it's trying to gun above it. Now, what we do once we get there, who knows? But you want to see price reach for daily highs and lows, because that's where the momentum is. And where the momentum is, if you get everything else lined up with that, you will see absolutely stellar results. Okay, DKM, thank you for your comments about the thread, and stay tuned. It's going to get a lot more interesting. Some really good concepts I'm getting ready to release. So I will continue absolutely to enlighten you newbies. Yes. And for you guys that's been around for a while, that's lurking, I see you too. Okay, AK, interesting way of teaching me what your pronunciation is. And well, yeah, the scalps, you can consistently draw in your weekly objective, pretty consistently with just scalps. Yeah, and my scalps are like 20 to 30 pips. I'm not a fan of individuals that want to trade 10 pips or less. To me, it just it's gambling. You don't have an understanding of what you're doing if you're doing trades like that. And there's no excuse. You can't tell me because you have a job or you only want to look at a 1 minute and 5 minute chart. It just screams novice, and I'm not trying to be egotistical by my comment. I mean, I'm saying that because that's how I tried doing it also. The Forex lulls individuals into thinking that if they have their 1 minute and 5 minute chart up, they can just go in there and take, 5 pips here and 6 pips here. And, you know, can you do it consistently? Okay. And long term without having, your drawdown eat away and erode your account? That's difficult for new traders to do. Myself personally, I have dabbled with a 10 pip system in the past, and while it is profitable, and I've had systems that I've come up with where taking 15 pips out of the market once or twice a day with a success rate of 90 and 95% accuracy, even that accuracy is no reason for me to go in there, because number one, I don't want to be in front of the chart all day. I can make more money trading the way I'm teaching, and I'll harvest more pips than I would if I sat in front of the monitor all day. And not to mention the fatigue factor that comes in. There's a lot of energy expended just looking at the chart, because you're not giving your brain any chance to rest, and you're burning calories, while you're staring at this chart, and you're burning every day when we wake up. Much like the market, we have a battery life, okay, and I want this battery to last as long as I can throughout the day, and I don't want it burnt on trading. I don't want to be looking in front of a chart, and wasting my emotional battery, my psychological battery, and my physical battery, okay, looking at a chart, constantly asking myself every minute or 5 minute or 15 minute, is it time to take a trade? Is it time to take a trade? Should I take that trade? It's very stressful. Even though you may still be profitable if you're doing it, to me personally, it's not beneficial. And when I finally learned how to approach the market on a professional level and allow the setups to take place on a higher time frame, such as a 1 hour minimum, and using a 15-minute chart to key in as my entries, fine-tuning it maybe with a 5-minute chart if I really want to narrow down the risk, my trading became a lot more relaxing. And while I still can be a day trader by definition, I consider myself a swing trader, because to me, scalping is, it's a bread and butter way of trading it. But unless you're at least getting 20 to 30 pips, if you're trying to shoot for targets less than that, I think what will eventually happen is, because your risk to reward can't be that high on a 10 pip trade, because you got, number one, if you're only trying to make 10 pips, and let's just say you're trading the pound, the average spread on that is about 4 pips. So you're looking at almost 50% underwater of what you're hoping to make. How can you get a realistic risk to reward ratio on that? So that's why my trades require a minimum of 20 to 30 pips of profit, and that's based on using swings of ideally 40 pips of a swing. Then you draw a fib across that swing, and 62% of that, okay, should get you anywhere between 20 and 30 pips. So I hope that answers your question, but if it didn't, I'll just basically say you can, yes, make all of your weekly objectives if you're looking for 50 to 75 pips. And honestly, my pip objective is 75 to 100 pips a week. If I get above 100 pips for the week, I'm absolutely tickled to death. But using my equity plan of what I try to shoot for in terms of for the year, for the quarter, and for the month, and then for the week, that's how I break my goals down. I don't really look for like a daily goal. I think that gets people in trouble doing that. But for a week, I absolutely have a goal, and there'll be opponents to that concept of saying that if you have goals for the week, you shouldn't do that, because if you don't hit it, blah blah blah. Okay, I understand all that. I mean, I've been doing this for a while, and I can certainly respect that. But here's my concept: if you aim at nothing, you're going to hit that every time. Now think about that. If you don't have a goal and you're not aiming for something, the target, which is nothing in that case, you'll hit that. by that I mean you won't have a plan. You won't be happy with the fact that you made 75 pips or 100 pips for the week, okay? And maybe pocket it and go away and leaving it for the next week to trade. And what'll happen is you'll be not satisfied with that. You'll go in for looking for more, and you end up giving it back to them, and sometimes with interest. And I can tell you, at the level of trading I've been, it really, really aggravates you when you get in there and you take a couple hundred pips out of the market, and sometimes really early in the week. And my first year in forex, I had instances where I've had 300-400 pips for the week, and wasn't satisfied. I mean, I allowed greed to seep into my trading, and I thought that I was going to be able to squeeze one more drop out of that lemon, and man, I gave a good portion of that back to the market. Sometimes all of it, simply because I allowed greed to get involved with the trading. So when you get developed discipline and you have these low range, and I know this is not sexy to you guys. You want to see 100 pip trades like you're seeing sometimes in these videos, but you don't get to that level unless you get to 50, 75 pips for the week. When you start consistently doing that, and you start seeing these patterns and these techniques start to develop before they unfold, then it allows you to start seeing longer term swing setups that you can take these trades that I'm illustrating. I'm not posting them to brag. I'm not posting them to measure mine against yours or whatever. I'm sure there's other people that's made more pips this week than I did. The only thing that separates me from them is, number one, I can't spend their money and they can't spend mine. My equity management and the compounding of my money, I think, is what sets me apart. And there may be individuals on here that's making much more than I am, and they're sitting back quietly, or I haven't looked at every thread, obviously, but maybe there's someone that's equal, if not greater than I am in terms of what I've been able to do in the market. And that's awesome. But that's my money, and your money is your money. And it's important for you to have a realistic goal, and I think absolutely 50 to 75 pips a week is certainly doable just in scalps. And well, think about it. If you have a objective of 50 pips for the week, you only need to have 225 pip trades for the week, right, guys? Or how about this? You catch one swing, okay, that starts off as a day trade and a scalp, and you trail it up, okay, and you squeeze out 50 pips, you're done for the week. But here's the question. Are you going to stop looking at the charts for the week? Probably not. And if that's the case, that right there tells you where you're at in your development. Where are you at in your discipline? Can you turn off these charts, put a movie on instead of watching the Asian session, okay? Sleep all night long through the London session. If you've already made your money, be done with it. Absolutely be done with it, okay? There's no reason why to be in there taking every single trade. If you have this mindset, I'm telling you, I can't stress it enough, your trading will absolutely turn around if you can do that. And the problem is you need to determine if you're going to have the discipline to be able to do that. Okay, hi George. Unfortunately, there's a couple Georges that email me and linked through YouTube, so you'll have to forgive me if I don't know exactly which one you are, but I appreciate your feedback, and I certainly am glad that you're finding some insight in them. So keep at it, hang in there, and there'll be a lot more to learn. So thank you very much for that. Okay, Shandy, this post is the star post for this feedback session. I was very honored to receive a compliment like this. Initially, when I first came on, and I understand there was a lot of individuals that felt that I was going to peddle a method or maybe a gimmick or some kind of wear for individuals. And unfortunately, when I was deleting the posts in the other thread, I was aiming for a more structured approach and have it all in one post, but Baby Pips locked it down by the request of I believe it was Sweet Pip and a couple of individuals. So the original what every new or expiring forex trader wants to know thread that still is on the Baby Pips site. It's locked up right now, and it won't let me go in and change anything. So that's the reason why I really started this thread, because what I had envisioned then, and I was deleting everything, I wanted to consolidate it and put it in one spot. They locked it down. So if you do see that thread, there's going to be some exchanges between individuals, because drama got involved, and some individuals that either felt the need to be, confrontational or adversarial. It got really ugly, and I was trying to do what this thread has up to this point has been successful in, being structured, being very helpful, not just simply because of my input, but other individuals have picked up the mindset as well. And that's what I'm trying to do. Even though the babypips.com is an excellent resource for new traders, and it has a community of individuals, I'm trying to develop a community within itself that has a uniform and common mindset or approach to trading. And I think when we get to that point, and we're starting slowly to get to that point, that way you're not relying on what ICT is posting. What you'll be doing is you'll be posting what you're seeing, and then everybody's light bulb will start clicking at the same time. They'll say, oh, I see that as well. Oh, I saw that, but I didn't do the trade, but I still saw it unfold. And that's when the learning will start really ramping up exponentially, because there'll be these little moments where it's like, aha, I get it. But until you consistently do the same thing over and over again, and not by applying there's another gentleman on here, Pete Fader. I've read his thread, and very good trader. And I know he trades with volume and all these other things, and I don't. It doesn't mean that method is not good or unprofitable or profitable or whatever. It just means that if you start applying all these extra little things, if it's benefiting you, great, okay. But if you ask me things outside of what I use, don't think that I don't think it's profitable or it's a beneficial method for you or someone else. It just means that these are the tools that I've adopted and I've gotten accustomed to. And it's not that I think I'm a better trader than anyone else or my tools are better than anyone else. It just means that the concepts that I have elected to use for my trading have worked out for me. And they're very generic. They're not real fancy. They're not real gimmicky with indicators. And have you noticed, I think I maybe mentioned indicators in this thread and in these videos maybe 3 times. And I just referenced it in response to what other traders might be looking at, like the MACD or the stochastic. My indicators, quote unquote, are really based on price. Like the SMT, Smart Money Tool, I'm measuring price, the reaction to price. When you start looking at the spread charts of futures contracts, like the nearby and next month out, if you plot the close on a line basis and you plot that on a daily chart, you can start seeing the same similar like SMT divergence, and you can see that as well. And it's not an indicator like you see. You're measuring price. My indicator is price action. I'm a student of price. I will always be a student of price. I've not mastered anything except for me. I've mastered me as the trader. So I think that's the only thing that really sets me apart from those that are posting in this thread. And again, there's so many threads on Baby Pips. I've not been able to, and I'm not going to try either to read every one on. But I think that's what makes me different. And I really appreciate Shandy coming out and complimenting the thread and the effort that's being expended on it. And I certainly am thankful that I'm helping others. And I'm glad that I was able to not necessarily prove, but just confirm what I had basically started the original thread on. This was the whole intent from the beginning. It just got sidetracked with individuals that I guess for whatever reason felt that they had to stir up the pot. So again, thank you very much for that, Shandy. I appreciate that, and good luck and good trading to you as well. Okay, yeah, Shandy, you've that's absolutely the right analysis. And let's pull your chart up real quick. And yes, you have old highs in here, and your retracement level pulls you right back down into it. And yes, it was a potential optimal trade entry. So yes, it was very profitable and good trading if you got that. App Monster, I appreciate you helping DK out. It was very nice of you. So that's what I'm talking about. I mean, I'm sorry about that. Cell phone ringing. Murphy's Law. Whatever can happen wrong, it will. All right. Yeah, basically, I really appreciate you helping out, and that's what I like about the community we're developing here. It's very helpful to one another. So that to me is very refreshing. Thank you again, App Monster. All right. Okay. This is pretty neat. The perfect storm trade. That's pretty wild. Fully paid up follower. I think that's cool. All right. There's a couple things in here I wanted to make reference to, and your point number 5. This is in notes that I'm preparing for nailing down a loaded deal where your odds are 10 to 1 on a trade. You don't get very many of them, guys, and don't start salivating yet. But you have a potential setup that is generic, that happens a couple times a year, where it's just very loaded and one-sided, and it's very hard to be wrong on the trade, and usually nets a good chunk of pips. But it involves open interest. Now, up to this point, I think everyone is assuming that just simply because open interest drops, that's a buy signal, because commercial traders are lessening their shorts. And if open interest increases, they believe that is a short because they're increasing their short positions. And that is not accurate, okay? The point is when you're in a trading range environment, when you're in consolidation, okay, when open interest drops while it's consolidating, that is commercials indicating to you that they're lessening their short positions and they're expecting price to break out to the upside. So you breakout traders, if you want to be breakout artists, that's how you trade the breakouts. Okay, use open interest in consolidations. Now, the way you factor where there's an 80% success rate using open interest, okay, you want to see a market trade up and then go into consolidation and then see open interest drop. Then you have a very high odds likelihood for price to move up to the upside. And versus contrary to buying, flipping it around to look for a short, you want to see price trade down into a consolidation. When it trades in consolidation and then trades with open interest increasing during the trading range or consolidation period, that is indicating that the commercials are adding to their shorts and they expect the price to break down to the lower end of the range. Okay, so don't just look at open interest dropping and just saying, okay, well, I saw open interest drop, it's probably going to be a buy. No, that doesn't mean that. It just means that if you're in a consolidation range, then it drops, okay, that's a buy signal that way. But there are times when you'll see open interest drop in a consolidation, and if price is in a downtrend, it may just be a little blip of price movement where it takes you about out of the range and then find another resistance level to short from later on. So the way you qualify a really sound open interest trade, if it's decreasing, it's a buy signal if the market is already predisposed to a buy signal. Okay, so again, we're just using this as one more patch to fill in the ideal buy or sell pattern. Okay, and you don't need to see open interest decreasing on the USD. Okay, USD, all we're looking for the dollar index to tell us if it's bullish or bearish. Okay, you just want to be looking for your your directional buys that way. You want to use open interest on the nearby contract of the currency pair you're trading. You don't want to look at the open interest on the next month out, because the most active trading will be done on the nearby contract. So you're not using total open interest like COT data is. COT data takes into account to all the contracts being traded, and that's not what you want to be looking at, just the nearby contract. Also, I'll throw that in there as one more nugget. And I think there was something else on here I wanted to mention. Unfortunately, when I get on here and I start talking, points that I see while I'm talking, I can't get back to. I don't script this out. I'm basically as I'm going, so I apologize if I miss something. If I do, I'll come back with another video and add it to it. But there are a lot of things in here that are very, very strong. Okay, and by doing this, you can absolutely nail down some good trades. This right here, minimum 40 pips, that is for ideal setups, guys. Okay, you want to see a pip swing of 40 pips to measure your fibs on to get a really high probable trade. And again, that gets back to what I mentioned earlier with scalping. My scalps are 20 to 30 pips. So if you use a range on a swing of 40 pips, that'll give you that ballpark number for your trades to be in my category of a scalp, 20-30 pips in magnitude. So it doesn't mean you cannot take a trade with a swing that happened to be under 40 pips. It just means the probability of netting a nice chunk of pips is lower than that of the market moves that start with a swing of 40 pips or more. Okay, so that was the other thing I missed that I remembered. So excellent, excellent post, Jordan. Okay, UK Dave. You've nailed it down perfectly. I classify my trades into two types of categories. It's trend trade, where you're trading in line with market flow and trend, if you want to call it that. And while they still require the same tools and maybe same concepts and techniques that a pivot trade, a pivot zone trade would be, based on just simply, are we buying in the buy zone or selling in the sell zone, and then trading usually from one pivot to the next. Okay, and then that's a pivot zone trade. A trend trade is when you're trying to look for a breakout and continuation, like in the event we saw on Friday, where granted it was a trade, it started off as a pivot zone trade, but because of its price action, it turned into a trend trade. So they're very good post and excellent understanding so far. So kudos on that, UK. All right, the simple man. Thank you for this post. And yeah, 25 pips a week if you net that, and you risk no more than well, if you risk 2% per trade. And I don't suggest new guys do that, but if you risk 2% per trade and you net 25 pips for the entire week, you will make over 100% on your equity, and it'll double every year. So yeah, it's very easy to double your money in trading, but it takes a lot of discipline doing it. So thank you very much for sharing that. It's very good. All right, LS1. Well, obviously you can see, because of the analysis I mentioned earlier in the video, that everything was bullish, and I don't like the trade contrary to when things are so strong in one direction. We can see R1 and R2 present resistance, and sometimes it does present opportunities to get a couple pips, but I would advise you not to do this, because while you were profitable here, it's very, very high risk. And a lot of times what will happen is when markets move like it did on Friday, the last hour or so, the banks will really dogpile and throw the market up really, really high, because retail traders are doing just what you're doing here. They're trying to sell the top, and if they get a huge number of flows on the retail side shorting it, they'll blow them out of the water, and it's easy for them to push the market 80 pips, 100 pips, even farther up, and it leaves retail traders scratching their heads thinking, what happened, how this happened. So again, I would advise you not to trade like that again. everything was too bullish for you to be looking for a top in the market, even though Friday was justification for you to think people would square their trades up. Obviously, it was fundamentally driven on Friday, so you can't fight the fundamentals when they're lined up with technicals. So don't short in situations like that. Okay, AK. All right, lowered your pip range objective for the week. That's good. 1% per trade. Well, you know what? Honestly, until you guys are consistent, I would like to see you doing 1% or even less. Take the leverage out while you're learning. You're not going to learn anything, okay, losing money as you learn. So you deleverage, take it down to risking 0.5%, and take 100% of the risk out if you can, and trade 1-to-1 and learn the concepts. And as you get more proficient with it, increase the leverage that way. And I think that will end this feedback session. And I wish you good luck and good trading, guys.